Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the market analyst here at HF Markets. And I'd like to welcome everybody to a very important topic that we're going to be looking at over the next 50 minutes. Today's topic was actually chosen for a specific reason. There has been very recently a survey where investors and traders were both answering what they find is the most difficult aspect of trading the financial trading markets. Now, there was some very good answers. For example, one of the most popular answer was volatility. Another very popular answer was price action after news announcements. But the second most popular answer was actually false breakouts. So today we're going to be looking at false breakouts because a lot of individuals, both short-term and medium-term traders, a lot of the time are either looking to trade the trend, are either looking to trade the price movement after the price range. And for this reason, it's very important to be able to determine how the price, to be able to determine if there is going to be a false breakout or if there's going to be enough volatility, enough momentum in one direction of the market in order to be able to ensure yourself that yes, this type of price movement in this period of time is going to take place and it's not going to be a false breakout. In order to determine this, we're of course going to be looking at aspects of technical analysis, of fundamental, and as well we're going to be looking at component analysis and order flow analysis as well. So we're going to be touching base on different factors to ensure that we are able to determine what type of price movement is potentially going to take place. Now, before we start looking at breakouts, of course, this webinar is going to be split up into a couple of sections. The first section, ladies and gentlemen, is going to be just a very quick introduction. The second section is going to be understanding the very basics and looking at some examples of the different types of false breakouts you need to be cautious of, and also why false breakouts actually occur as well. And then towards the end of the webinar, in the third half of the webinar, which is going to be the largest part of today's topic, we are going to start looking at, of course, what abilities, what options we have, what solutions we have in order to ensure when we are trading and we are looking at a trend where we are looking at breaking out of a price range, or even at the other conditions in the market, such as reverting price conditions, ensuring that we are indeed able to determine if there's going to be enough momentum or if it's going to break, lose momentum and correct back in the opposite direction, in which case it will form a false breakout. Now, the first thing we're going to look at is a very quick introduction. Now, what I want people to be aware of as part of this slide is, of course, these webinars are not here to give investment advice. You know, we get a lot of questions about investments, about even other types of assets such as real estate. We're not here to give financial advice, but what we do want to do is, of course, give as much educational material as possible in order for you to be able to have the knowledge and confidence and expertise, and of course, as you are trading slowly, the experience as well, in order to be trading with confidence and knowledge in the financial trading markets. This is what we want to, of course, do. And in order to do this, we will, of course, give as much educational material as possible. The other thing I want to say is, of course, the great thing of and the great thing about these webinars is, of course, that it is also, you have the ability to ask questions and get answers to the questions instantly. So this is another very important factor as well. I can see a couple of questions as well. Of course, I will answer those questions. The last thing I want to say as part of this slide is, of course, we are looking at investments. As with all investments, there is a risk to the capital that you are investing because, of course, you are speculating the direction of the price movement, and of course we have no control over how the price is going to move. So it's the same as every type of investment. It is an investment. A certain level of risk is involved. So we have to understand this. We have to be comfortable with it before proceeding to a full investment. Now, if for whatever reason you don't understand the risk, or you have some questions about it, of course, this is a great time. And of course, this is a webinar where you can ask questions about that. This is the last slide, then we're going to go straight to start to looking at false breakouts. This slide I don't want to spend too much time on because it's not important to your trading and your success. It's not important to today's topic, but I do think it is important to know a little bit about the individual who is providing you with this information. So my name is Michalis. I'm the market analyst. A bit about my background. I originally was a financial advisor in London for 4 years. Been a market analyst now for almost 6 years. Been investing and in the financial service market for 10 years now. So that's just a little bit about myself. But like I said, I don't want to spend too much time on that slide because it's not going to help you succeed. It's not going to help you profit, and it's nothing to do with today's topic. But it is nice. It is important to know a bit about the individual who provides you with the information, of course. So what is a false breakout? Like I said, in the latest survey, it is one of the biggest issues that individuals are coming across. Whether you're a short-term trader, whether you're even a long-term trader and trying to build portfolios, it's still a massive issue. So it's important that we understand what false breakouts are, so we have it in mind that we need to be cautious of them. To understand the different types of false breakouts. And the most important thing, it's the most important thing out of everything we're going to say as part of this webinar, is the very last few slides, where we're actually going to look at solutions, well-known solutions in the financial trading markets on how to avoid breakouts. So very clear step-by-step instructions on things that you can do, even if you're a beginner trader that has never traded before, things that you can do to ensure when you are trading the trend, if you're trading in the direction of the trend, or if there's a price range and then you want to trade in the opposite direction, whatever it may be, to ensure that when you get specific types of impulse waves, to ensure it is not a false breakout and it is indeed correct analysis and it is indeed going to move in favor of your trade. But the first thing that we're going to look at, of course, is what is a breakout. So the first thing to know is there's two types of false breakouts. A breakout is when the price is either going to break out of a previous significant price, or it could be a reoccurring price range. So let's look at this very quickly, ladies and gentlemen. I'm going to draw a diagram, but then we will look at real examples as well. So what do we mean by significant previous significant prices? Now, everybody knows, it's maybe not beginner traders, but a lot of people know what support and resistance points are. These are significant prices. So if we've seen a reverting market condition, in which case the price is moving something like this, it's not a price range. A reverting market condition is a sideways price movement, but it has a lot of volatility. It actually has large impulse waves upwards and then downwards large corrective waves. So it shouldn't be confused with a price range. It is a reverting market. Now, when we get something like this, we of course get support levels, very strong support levels, and we also get resistant levels as well. Now, something for, of course, everybody to note is normally when we get one resistant level, when we come back up to that level again, the resistant level and the psychology of traders are quite strong. That previously we found we collapsed at that level. When we come to the third time, then of course it slightly weakens, because what investors say is, okay, the price keeps coming up to that level, it keeps increasing at that level. So of course, the more the price is going to remain there, the more comfortable investors will become. And then of course, when it comes there to a fourth time again, especially if we're going to see ascending triangle patterns. So for example, price movements like this, in which case we're finding resistance at that level, but we also got an upward slope. Then really the sentiments of investors are really going to start to believe there's going to be a breakout, because of course we're getting more comfortable with that price. Now that applies both to when the price is increasing, it applies both as well to when the price is decreasing. Now what exactly is a breakout? Now if we look at a bearish breakout, is when we get some downward volatility and we're breaking out of that pattern. So this is the point where we get a breakout. So here we can see it's a significant price level. We're again consecutively finding support at that level, and then we've broken out of that. So that, ladies and gentlemen, is a breakout. Now there's different types of breakouts. The main two types of breakouts though that we're going to be looking at is breakouts which are related to the trend and breakouts which are related to the price range. We're going to look at real recent examples for both. Now a false breakout though is because of course that's looking at a breakout. So it's breaking out of that pattern, whether it's breaking out of the significant pricing, breaking out of the price range. Keep in mind, ladies and gentlemen, because I can see a quote, somebody's just asked a very important question. Somebody said, what is the significant pricing when we're looking at a trend? Because of course that was reverting markets. When we're looking at trends, ladies and gentlemen, you will notice that a trend looks something like this. We have what is known as higher highs and higher lows. So each low price, so each downward momentum loses momentum at a higher price. So we get higher lows, and then we also get higher highs like this. This is a formal upward trend. Now, what's the significant pricing? When we get an upward price movement and a downward price movement, this is the significant pricing here. So what is the breakout? The breakout is as the price starts to trickle upwards like this, if it crosses this level like so, then of course this was the breakout level here. So keep in mind, just to answer that question, that's where the breakout level is for trends. Applies both to bearish and bullish trends. Very, very important. Okay, we're going to look at real examples on how to ensure that we are going to get a continuation of the trend and it's not going to form what is known as a false breakout. So now we know what a breakout is. What is a false breakout? A false breakout is when the breakout takes place. A lot of the time it can take place with a lot of volatility, so don't let that fool you. But it is unable to maintain momentum. And what actually happens is a lot of the time it can either retrace and correct back to that price range or that reverting price bracket, or it can see a completely different trend altogether. In which case, if you did enter, and a lot of people do enter, especially if there's a lot of volatility, potentially maybe coming after news as well, we're going to look at some of those examples, then you really need to be cautious about, when it corrects and moves against you, to close the trade, especially if it's going to form a completely new trend in the market. So for example, we may be looking at price movement like this, our breakout levels here. We may get a lot of volatility like this, in which case we got a breakout here. A lot of people are saying, great, we've had this news. It's telling us that the dollar is going to become more expensive. It's positive for the dollar. Interest rates will stay higher for longer, etc., etc., etc. This is just an example, but it's actually a false breakout. What happens is the price starts to do this after, and it doesn't not only decline to that previous range that we're seeing here, but it's actually declining low. It's a completely new, different trend. We're going to look at why this actually happens as well. So keep in mind that this is a false breakout. So we get the breakout, but it's unable to maintain momentum. What actually happens is that it corrects either back downwards to that previous bracket or the previous significant price, if it's a trend, for example, or we get a completely new trend, in which case, if you haven't exited, it's a really difficult scenario. So we want to avoid these. We're going to learn today specific methods on how to avoid these. And it's also important because it's not just about avoiding them, it's about when you want to enter and you want to take advantage of the market, to make sure you're entering at the right moment to ensure that it is going to be a profitable trade for you. and we're going to look at very well-known techniques for these. False breakouts are one of the most difficult scenarios in trading. How can we reduce this issue? This is what we're going to be looking at today. There are two types of breakouts. We've got trend breakouts and we've got price range breakouts. Now, there's a lot of different types of breakouts. There's probably 40, 50 types of breakouts. But if we're going to categorize them into two categories, all the different types of breakout will fall under these two: trend-based breakouts and range-based breakouts. False breakouts can appear on all assets. So I got a lot of questions a few months ago when we looked at this topic, because it's been quite a long time since we've looked at this topic. But a lot of people said to me, I want to trade the trend, I want to avoid false breakouts. What's the asset which has the least false breakouts? Which is a very difficult question, because false breakouts can be seen on every single asset. Something which will make it easier for you in terms of maybe it will be less frequent is, of course, the more volatility there is in the asset. If it's a more volatile asset, the more possibility there is of there being false breakouts. So for example, if you're going to compare, this is just an example now, the Turkish lira against the Turkish lira US dollar, which is an exotic currency pair, and you're going to compare it to, for example, the euro against the USD, most likely the exotic currency, which is a thinner market, thinner volumes, more volatility, potentially can see more false breakouts. So let's start to look at trend-based false breakouts. Now, we're looking here at a downward trend. This is the first thing I want people to understand. This here, ladies and gentlemen, is a downward trend. So we've got lower lows all the way here, and then we've also got lower highs up to this point here. So when is the trend officially ending? This here, ladies and gentlemen, we're going to look at price action. The trend actually ended in this area here, because it's at that point that we actually got a higher high. That doesn't mean the price didn't decline after. It did decline because we get a false breakout, but the trend ended there and a new downward trend started to form thereafter. Now, there's different types of false breakouts here, ladies and gentlemen. Now, a lot of people, especially people that are trying to research themselves, they're looking at YouTube, be cautious. There's a lot of influencers who are looking at an analysis, looking at the market, analyzing the market, and a lot of the time they're saying trade breakout. Now, the issue with breakouts, ladies and gentlemen, and I'm sure everybody that's watching today's video would have seen somebody who says, you know, you want to trade the trend is higher highs and higher lows, so trade the breakout and you'll be trading in the direction of the trend. Now, if we look at this breakout here, ladies and gentlemen, this here is a breakout, all right? Look at this for a moment. What is the issue here? And like I said, all influencers are looking at this. We'll look at the next breakout as well. Look at this breakout here. This is the breakout of the significant price. So all these so-called educators online are saying trade at this point in the market in the direction of the trend. But what's the issue here, ladies and gentlemen? This is the downward price movement in our favor that we want to be trading. Now, if we're going to trade the breakout, this here is the only part that we're able to trade. So we're trading at the very end of the market, the very end of the impulse wave. So we've missed all of that price movement, and we're trying to trade the smallest price movement in the overall impulse wave. Another example here, if we're looking at this downward trend, so much price movement in the favor of the trend is happening before the breakout. So why are so many people trying to trade the breakout? Okay, so this is one of the scenarios that we're going to look at. This is one of the things that we're going to look at today in terms of ensuring that we're entering at the right point in the market and avoiding false breakouts, okay? Because even if there's not a false breakout, here we can see, ladies and gentlemen, that yes, there is false breakouts, but nonetheless, the overall price movement, if you're holding on to your trades and you've got that margin, is in the direction of the trend. So it's not necessarily that bad, but nonetheless, why enter here and miss all of this price movement? Whereas if you entered higher up, and I can show you how to identify this, if you entered higher up, you would have entered the market, you would have earned a profit, and you would have exited before the false breakout even formed. ladies and gentlemen. So you would avoid this market price movement against you. Okay, so this is something that we're going to be looking at. Now, like I said, this downward price movement and all these breakouts downwards, even though there were false breakouts, eventually the price starts to move in our favor. So it's not a big issue, but sometimes it is an issue. If we look at this upward price movement, we get a retracement. We actually have higher lows. Okay, so some people may be thinking, okay, maybe the trend is about to change. This is our significant price level. We broke above it here. So a lot of people were saying, and keep in mind, that's a lot of momentum. Look at this, the size of this candlestick here, the bullish green candlestick. That's a very big candlestick, a lot of momentum. So a lot of people are going to be saying the trend is ending, we're going to trade upwards. Maybe this is being caused by news, for example, as well. But what happens? We break above, we go higher, we see momentum here for a very short period of time, and then we get an even bigger price movement in the opposite direction. So this is a very clear example here. Okay, so we need to be very cautious of trends and breakouts, false breakouts. Now, this is an example of a price range. Now, when does a price range a lot of the time form? A price range will even form a lot of the time where there's not enough economic data, when there's been a very important announcement, and there's been big price movements. So you can see here very big price movements, and because of this, ladies and gentlemen, the price has become expensive. People don't want to sell, but people are uncomfortable to keep buying. And then what happens is we get very few orders and we start to move sideways. So you can see here sideways price movement. This is a price range. We can see the range is keeping in between these yellow lines. When do we get a breakout? Sorry, green lines. When do we get a breakout? The breakout happens just after this red line here, ladies and gentlemen. Just after this red line, tuck, we get upward price movement and we get a breakout. What happens? The price corrected back downwards. We get another breakout, okay? No upward price movement, and then the price completely collapsed, okay? So you need to be cautious about breakouts, okay? So what do we want to do? We want to identify that this breakout here, we shouldn't be trading, and this breakout here, we do want to be trading. So how can I differentiate between the two? How can I identify that that's going to be a false breakout, but that's going to be a trend, an impulse wave with a lot of volatility that I can take advantage of? This is what we're going to be looking at today, okay? Because we want to avoid this breakout. And look at this lovely price movement. This is strong, steady downward price movement, a lot of volatility, and we're looking at a steady price movement. There is no retracements here, ladies and gentlemen. Throughout this, if we look at 11 candlesticks, only the one candlestick is green, and none of them are forming retracements. So very short price movement. That's the type of price movement that we want to be taking advantage of. So before we start looking at what we're going to do about it, how can we differentiate between the two? How can we identify this is going to be false price movement and this is going to be a stronger price movement? That, well, it doesn't necessarily, when I say stronger, it doesn't necessarily mean it's going to be a stronger price movement. It may be a weaker price movement, but it's not going to form a false breakout. Okay, so it doesn't necessarily mean, because there's no point there being a lot of volatility upwards and it's increasing in value by 2%, but then it's going to collapse straight away. And most likely the spread is going to be much higher because of the volatility. It's better to trade a more steady price movement, which is going to be 1%, and it's not going to last 20 minutes, but it's actually going to last 20 hours. Okay, that's something which is going to be more advantageous to you as traders. So why do false breakouts form? Now, something which I always say is you have to think about how institutions think. If you're going to think like a trader and a very small trader, when I say small trader, somebody with a very small account, then you're going to struggle as part of your analysis. What will be beneficial is, even though if you are, you may not be, but even if you are a trader which is very new, has only got a small account, maybe $100, $200, $300, to think as a very large institution, which is actually trading millions and millions, if not billions. So because this is also going to answer why a lot of the time we get false breakouts. So point number one, traders want to buy during a bullish trend, but they want to buy at the lowest possible price. Okay. Point number two, let's look at that. It's connected as well. Traders want to sell during a bearish price movement. They want to speculate that the price movement is going to decline, but they want to do so at the highest possible price. This is a lot of the time why we get retracements. Retracements and false breakouts. And there's a lot of time in the market when I may be trading and I'll be looking at an upward trend, and maybe there's reason for the upward trend. I may be thinking to myself, that's definitely going to have an upward trend throughout the whole of the year. But I won't enter into the market because I'm saying to myself, I want to take advantage of the upward trend, but that's an expensive price. Is it really priced at that level? Is that the true intrinsic value of the asset? If not, it's not an issue. Let's wait for some sales. Let's wait for some people to start cashing in. The price will decline, and I'll enter at a lower price to take advantage of the upward price movement, rather than having to enter the buy here. So this is a lot of the time why we get false breakouts. And the same thing applies to downward price movement as well. Pending orders, a lot of the time we get pending orders as well. So a lot of people will say to themselves, if the price is moving like this, I want to take advantage of the upward trend, but I don't want to enter at such a high price. I want to enter at a lower price. So I place a pending order here. So if the price declines and it hits that pending order, then I will buy. Now, if there's 5,000 individuals there who are entering pending orders at that level, then what it does is it creates an imbalance between buy and sell orders. So what actually happens after that is we get strong upward price movement because of pending orders. And the same thing applies as well to when the price is moving upwards. Maybe the price is moving upwards and people will always say, if it hits this price, this is where I'm going to sell and cash in my profit. So let's say if we're currently at $80 here, we may put out $100. If the price hits $100, I will sell. So that enter a pending order here. So if the price continues to, maybe it might move into a price range like this and then move upwards, but then it will move back downwards. Why? Because there's so many people here cashing in their profits. So this is pending orders. This is also related, ladies and gentlemen. Everything here is also related to investors' unwillingness to enter at that price. Yes, I want to speculate in that direction of the market, but I want to enter at the most competitive price. It's like, for example, let's say I'm a salesperson. Maybe you're somebody who's entering the real estate market, and you're consistently buying from me, and I'm a real estate agent. And I come to you and I say, this property is worth 200,000. Would you like to buy it? No, I don't want to buy it 200,000. Okay, I've got another property. Would you like to buy this? It's at 200,000. No, I'm not interested in buying it. And I keep doing this for days and days and days. And then suddenly I come back with a lower price. And I said to you, the gentleman, look, this is the same properties I've been showing you over the past 2 weeks, but this property is worth 170,000. I will be more willing to buy at that price. So again, it's all about being more willing to enter at, it's all about if the investor is willing to enter at that price. Is he willing or is he unwilling? Because that's going to be the deciding factor if we're going to get a false breakout, or we're actually going to get a trend or enough price movement in order to benefit from. Now, of course, all of this is going to create volatility, which is why we get false breakouts, of course. I've got some questions. I will answer these questions, of course. So keep that in mind. It is important to know what's causing the breakouts, because this can help as well. Something which can help you with pending orders. You may not be able to have access to it on MT5s and MT4s, but you can get access to it from the internet, is looking at the depth of market. So if people take a note of DOM, depth of market, it will actually tell you where there is pending orders in the market. So you're able to actually say, okay, at this price, there's a lot of pending orders there. Do I really want to speculate and trade these upward breakout level, because there's a lot of pending orders. There's a good chance it's going to collapse back downwards. So this is something that you can do, and you're able to do this again because of that, because you're able to determine where pending orders are within the market. So let's quickly answer this question. I've actually got two questions. Let's quickly answer them. So some people said they lost connection and they exited for about 5-10 minutes. It's not an issue. Yes, you will be able to have the recording. You can also speak to our support team via the live chat, and they can give you the PDF of the PowerPoint and the live recording as well. Please show us how to read and interpret the depth of market on the MT5. Ladies and gentlemen, please keep in mind the MT5, the depth of market will show you where pending orders are on the real stock exchange. Okay, so keep that in mind. On the MT5, it's not going to show you where there is pending orders. And even if we showed you where there's pending orders on CFDs and derivatives, it's not going to have any influence over the price, because it's not buying or selling. It's not a pending order to buy or sell the actual asset itself. So keep that in mind. It's not the depth of market on the MT4 or MT5, because that's not going to give you any assistance in terms of where potentially there's going to be false breakouts. Okay, so just to keep that in mind. So now that we've answered those questions, let's continue. Now, as part of this slide, I'm going to mention a lot of things which are solutions. Don't worry, I'm not just going to mention them. We're going to go through everything step by step. I've got another question here, so let me quickly answer this question. Okay, so yes, keep in mind, we're going to go through everything step by step. So we've got a question about one of these. This is just a list. Okay, it's not going to help you in any way, shape, or form. On the following slides, we will go through them one by one. So I've got somebody who says, so it's useless on the MT5. Yes. The depth of market is useless on the MT5, 100%. This is also applies to, for example, somebody's trading and looking at volume indicators on the MT5. Volume indicators on the MT5 is basically a volatility indicator. It's not giving you any information on volumes. So for example, some people that right click and they go down to ticks and they think it's related to volumes, or they go on insert, they go on indicators and they look at volumes and they think it's related to volumes. It's not. It is related to volatility. Can be used. It's not useless, but not as a volume indicator. So keep that in mind. So solutions, steady growth. Now, if we're gonna go onto your charts, and I won't do it myself, and I don't want to waste your time, but you can do it yourself. If you go onto your charts and you look at all the false breakouts that you see over the past 2 months, or if we say this year so far, I guarantee you 95% of those are due to very high volatility. So for example, we get, let's say we may have price movement that looks like this, then we get downward price movement, we get price movement like this, and then high volatility, and then it will collapse like this. This is just an example. Okay, it could be a price range, so very thin, small volatility price movement like this. Okay, we got a price range here, a lot of volatility, corrects back upwards like this. When there's a lot of volatility, there is higher possibility of there being a false breakout. So keep that in mind, and don't take my word for it. Go to the MT5 and look at it yourself. You'll see that 95% of the time where there's false breakouts, there is a lot of volatility, and it's like whatever we declined. So for example, if we declined like this over 15 candlesticks, we've managed to increase the same amount over 2 candlesticks. Okay, so it's about traditional price action, and this is something that we do quite a lot on our live analysis webinars. when we look at live analysis, we go into the chart and we measure the price movement. Each time there's an impulse wave, we measure it. Each time there's a retracement, we measure it, because what we want to see is, where is there something which is out of character? If there's something which is out of character, then there's a higher possibility of there being a false breakout. So the first thing is steady growth, or a steady price movement, because of course it can be downward price movement. This is something that we're going to look to determine on a later slide. Another opportunity which we have, scaling in and scaling out. Now, some people frown scaling in and scaling out because they're saying it's just a way for people to more exposed individuals to the market. And again, this is the bad thing about watching influencers online, which haven't been financial advisors, which haven't studied economics, and not market analysts and so on and so forth, because they may use scaling in and scaling out to make you enter more trades. But if it's done correctly, it's not at a higher risk, and you're not more exposed, and you're not entering more trades. You're entering the exact same amount of trades. So a lot of people may say, instead of, if we get a price movement like this and it declines down to here, and you think it's oversold and you want to start purchasing and entering and speculating upward price movement, enter a buy here, enter a buy here, enter a buy here, enter a buy here, and close them all at this level here. So this is what is known as scaling in. Now, you may open one lot here, one lot here, and one lot here. So instead of opening one lot just here, which you would have originally done, you've now opened 4 lots, so 4 times more than what you previously were hoping to enter. Now, why is scaling in helpful? Because you are spreading the risk across 4 entries. So it's the timing of your trade is not as important, because it's not based on one price one time. It's based on 4 prices which are completely different at 4 completely different times. So instead of saying to yourself, let's enter and speculate downward price movement here, right, on the candle, look at the chart here. So I'm entering a sell here, and the price actually starts to move up. Everybody's scared. The whole of your trade is on that one pricing. You're not doing that. You're entering one trade there, you're entering one trade here, and you're entering one trade here as well. So even though this wasn't the greatest entry point, because the market starts to move against you after that, eventually it did very well. And this was a great entry point, and this was a great entry point, because you are mitigating the risk, you are spreading the risk, and this can help with false breakouts as well. We'll show you exactly how as well. Another thing though, ladies and gentlemen, like I mentioned, is you don't want to have more exposure, and you don't want to go outside of your comfort zone just in order to scale in and scale out. So if you get an upward price movement like this, and you want to speculate upwards, instead of opening one trade here for 5 lots, okay, let's say if you were willing to open 5 lots here, okay, instead of doing that, at this level, open 1 lot. All right, so instead of opening 5 lots here, instead open 1 lot. So here I'm opening 1 lot. Here I'm opening another 1 lot. Here I'm opening another 1 lot, here another 1 lot, and here another 1 lot. Okay, so I'm entering on 5 occasions. Overall, I've entered 5 lots. Okay, so I'm still exposed the exact same level compared to if I opened 5 lots here. Okay, so keep in mind, it doesn't mean you're going to be overexposed, doesn't mean you're going to earn more, it doesn't mean you're going to earn less. What it does mean, though, ladies and gentlemen, is you're mitigating the risk against different prices at different times, at different volatility points as well. I've got a question. Bear with me, I'll answer that question as well. Waiting for the correction and trading the second impulse wave. We also looked at a webinar a couple of weeks ago when we were looking at the second impulse wave. The second impulse wave is probably the least risky impulse wave to be traded. It doesn't mean it's not risky. It's still very high risk, of course, but there is benefits to trading the second impulse wave. Why is that? Because if you're trading the second impulse wave, it's definitely not going to be a false breakout, because the false breakout is on the first impulse wave if you're trading the price range. So the issue is solved there. 50% of the issue is solved. And number two, you're not trying to attempt to trade the trend before the trend forms. And at the same time, you're not trading too close to the end of the trend as well. You're in that middle bracket. So you're trading the second impulse wave. So you know there's not a false breakout. You know there's a trend forming in that direction. And you also know there's less possibility of you being at the end of the trend. Why? Because it's only the second impulse wave. It's not the third, it's not the fourth, and it's not the fifth. Ensure the breakout is in the direction of the overall trend. You don't have to be trading in the direction of the trend every single time. Of course, the trend does change, but if there's a breakout and it's also in the direction of the trend, there's a higher possibility that it's not going to be a false breakout. But though, ladies and gentlemen, of course, keep in mind, if you're looking at the fourth, fifth, sixth impulse wave in that direction, then you're starting to looking at levels of higher risk of the trend ending, because the trend is not going to last forever, of course. If the breakout is a correction, is there a reason for it? Why is the trend changing? So if the trend is changing, so for example, if we got upward price movement, upward trend like this, then we move up and form a a price range like this. If we get a breakout like this, why is the trend changing? If there's nothing there to indicate to us that the trend is changing, then there is a possibility that it is going to be a false breakout. Again, we're going to look at how we can determine this as well. Intrinsic value technical analysis. So this is what we were looking at on the previous slide. Is it really valued at that point? Are traders going to be willing to expose themselves to that price at that price? Or is it too expensive? Or are they uncomfortable with the downward price movement? This is something that we're going to look at. Of course, we're going to look at technical analysis as well. Point number 7, components. Component analysis. This is easier for me to explain on the next few slides, so I can actually show it to you visually, but that's something which is also very helpful. Number 8, probably not something people want to hear, but if you want to avoid false breakouts, don't trade the breakout. Very simple. We looked at this slightly as well, and we said to, we say, if you're going to trade after the breakout, if you're going to trade here, okay, you've missed all of this price movement. Right, and you're starting to trade very close to the end of the impulse wave. This is the impulse wave here. If you're going to trade the next breakout, this is the breakout. You've missed most of the price movement again, and you're trading very close to the end of the impulse wave. So there's higher possibility of there being a breakout. So instead of trading the breakout, to trade, what you can do, like I'm looking at the chart here on the right here, you can use Fibonacci. Ladies and gentlemen, so for example, we've got upward price movement here. Okay, it's actually forming a retracement. This is a smaller time frame. It's forming a retracement. The trend before, though, was downwards, which is why I say it's a retracement. It's actually doing something like this. All right, now the breakout is here. All right, so the breakout, people may either consider, bear with me. So if we're going to look at the breakout, especially if we look at it on a larger time frame, the breakout's down here, in which case you've missed all of this price movement. Okay, why would you trade at such a low price and you're missing all that opportunity? So instead of trading at the breakout, trade before the breakout. Okay, so here, for example, I've entered the Fibonacci levels. So the Fibonacci levels is before, it is here and here. All right. Now, I'm 50-50 on the Fibonacci, okay? Because no trend is the same, and the Fibonacci levels are always the same levels. So I will give you an alternative to the Fibonacci. But for beginners, just as a first step, you can use Fibonacci to help. So if it's going to decline below 60, the 61.8 level, you can use that okay, level here to actually speculate that the price is going to decline and form a breakout, a downward breakout. And the question is, if the price declines, and it declines like this, okay, what's the better place to be trading? Would you rather speculate the decline here, speculating the decline at the breakout here? Because if you're speculating the decline here, right, even if there is going to be a false breakout, you're probably going to hit your take profit anyway. Or as the false breakout starts to form, you'll close the trade and you'll still be in profit. Why? Because you're entering earlier, all right, rather than entering at the breakout, in which case you've missed most of the price movement. In which case, if it forms a false breakout, you either will end on a break even if you're very strict and disciplined, or you'll end on a loss. Right, so let's answer some questions, because I do have some questions. How do you only scale in if the first trade moves in your favor? I think it's easier. You'll get an answer to this on, then I think it's the next slide or the slide after, where we look at actual scaling in and scaling out points. If you enter scaling in levels, so for example, let's say if I say to myself, I want to enter a buy here, then a buy here, and then a buy here, okay? You saying, do you only continue to scale in if the first one is profitable? It doesn't necessarily mean my take profit is before the next trade. My take profit can be, for example, up here, right? So this trade stays open when the next one opens, and the next one will stay open when the third one opens, but all of them will close at that level, okay? Then you've got what is known as scaling in and out. So you've got multiple entry levels and then multiple exit levels, right? But again, doesn't necessarily mean you're closing one trade before the next trade opens, which is why I also said when you're scaling in and scaling out, you lower the volume, okay? So that way you're not overexposing yourself to the market. Doesn't mean you're increasing the risk. The risk level stays the exact same. Let's answer the next question. So when I'm in the 1 hour, the question is when I'm in the 1 hour time frame and it says buy, and then I go to the 5-minute time frame and it says sell, what should I do? Very simple, don't trade. Don't trade where there's conflicting signals, where the signals are conflicting and you're conflicting as well. Trade where the signals are the same. So when you're on the 1 hour and it says buy, and then you go to the 5-minute and it says buy, then okay, it's not conflicted signals, all right? Happy days. But if the signals are conflicting, don't trade. Even if it's conflicting all day, don't trade for the rest of the day. If it conflicts for 2 days, don't trade for 2 days. It's absolutely fine. As long as when you are trading, you're profitable, that's the main thing, right? Because you may have a full 2 days where signals are conflicting, and then the rest of the next 2 weeks, they're not conflicting at all. All right, so don't feel pressured into trading, okay? If something is conflicting, don't feel pressured into finding an opportunity in trading. Does a strong initial momentum breakout indicate a bearish or bullish trend? What do you mean? Are you referring to this chart here that we're looking at? Please clarify and I'll confirm for you. How do you determine the direction of the trend? You can look at breakouts, like we did on the previous slide, using the Fibonacci. You can use higher highs and higher lows. You can use crossovers. You can use trend-based indicators, and you can also use order flow analysis. It's better to watch the webinars which are based on trends, because we've got webinars which are directly based on trends. This is webinars not really looking at trends. We're looking at how to avoid false breakouts. So here, ladies and gentlemen, we have what is known as a breakout of the price low. So we have a low here, we have a low here, we have a high, and then we got the same level high. So we've not gone into a higher high. So this is a clue that the upward trend either temporarily lost momentum or has lost momentum, in which case there's a possibility of a downward trend. Now the breakout is here, ladies and gentlemen. Now look at this upward price movement, strong upward price movement, one candlestick, 15-minute candlestick that earned as much as what was lost on 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candlesticks. So it took 11 candlesticks for it to decline and one candlestick for it to move up the same level, okay, the same magnitude. So that's an indication there, ladies and gentlemen, that you need to be cautious of that price movement. All right. Of course, after that, it lost momentum because it was a lot of price movement in a short period of time. Now, compare that to this downward price movement. This is a steady downward price movement. So as it crosses over here, I'm more than happy to consider if it's going to potentially decline. And also keep in mind the size of the candlesticks start off steady, more or less the same size, again more or less the same size, and then it's later on in the trend where the momentum is gained. It's not gaining from here, and we got a big candlestick like this, and then it's lower price movements like this. Okay, it's the opposite. So this is the first thing, steady price action. Now, it's not that alone is not going to save you, but this is one very basic thing to keep in mind. The next thing, this is scaling in and not scaling out, okay? I will give you an example of also scaling out as well. So here we've got a price range. We can see it's a sideways price movement. We can very clearly see where the range is because we're finding support at the same level. We're finding resistance more or less again at the same level as well. Then we get a breakout. Okay, so how can we assist with the breakout, ladies and gentlemen? Instead of entering 3 lots here, okay, instead of doing that, don't open 3 lots there, because if it is a forced breakout, then your trades are all entered. Okay, instead of doing that, open 1 trade here, 1 lot, then open 1 lot here, then open 1 lot here. Okay, so if we get indeed a price movement like this and then like this, only 1 trade was entered at a much smaller price. Okay, so this can help with risk management in terms of forced breakouts. Okay, now this is what also I mean by we're not scaling out. So we've entered here, I take profits here. We've entered here, I take profits here. We've entered here, I'll take profits here. Okay, now if we're scaling in and scaling out, we also will have a take profit here and a take profit here. So here, this trade, the take profits here, this trade, the take profits here, and this trade, take profit is here. Okay, this is also an option as well. This is scaling in and scaling out. So this is a breakout. Okay, this is something very effective, ladies and gentlemen. It pretty much eliminates the forced breakout dangers. There still is a danger of if the trend is going to change, if you're holding on to the trade for too long, if your entry is correct, and so on and so forth. But forced breakout is not an issue if we do this. Okay, so breakout, retracement, trade. So when it breaks out, wait for the forced breakout to form. Okay, it breaks out, don't trade, wait for it to correct, and then as it starts to move back up again, trade the continuation of the trade. This is also what we said about trade the second wave. Don't trade the first wave. Don't trade the breakout. Breakout, wait for the retracement, trade the continuation. It's absolutely fine. And it also doesn't mean you're going to miss out on the price movement as well. I'll give you an example. So here we can see a reverting market. It's only a temporary reverting market. It's not a long-term reverting market, but we can see we're finding resistance here, resistance, resistance, support, 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 support. Okay, so very clearly see here we've got breakout levels, which is why I've drawn lines there. A lot of people will do this as well when they're trading. When they're trading, they'll draw lines at the breakout levels. Now, what happens? This is a false breakout. Declines, quite a lot of volatility. What happens after the decline? Price moves straight back up. So anybody who saw that decline probably was thinking it's in the direction of the trend as well. Okay, this is exactly why I put this scenario, because it is in the direction of the trend. But trend is changing. It happens in the market. People would have been selling. A lot of people would have sold at this point. Some people would have opened pending orders at that, and they may not even be on the MT5. The price moves against them. Okay, price moves against them, would have been in a losing trade. So instead of doing that, here you can see another breakout. Okay, so we've broken out here. Don't trade. Don't trade. Wait. Okay, the upward price movement has happened. What happens after that? Price declines. This is again a false breakout to a certain extent, even though the trend continues thereafter. We broke out and then it declined. Okay, so wait for that decline and then trade this price movement. Okay, don't trade the breakout, trade the continuation after the retracement of the breakout. Okay, this helps a lot. And people say, well, you're missing the price movement. Not really, because instead of entering, let's clean up the chart here. Instead of entering here, but keep in mind, I'm not trading a breakout here. You could have. I'm not trading a breakout here. We said trade before the breakout. Okay, so I'm entering here rather than here. There's not much of a difference, ladies and gentlemen. If it's the difference of me being a profitable trader, it's absolutely fine. Okay, so breakout, wait for the correction, trade the continuation. Technical analysis and component analysis. So the first things first. This is also something from yesterday. This is the NASDAQ, the USA 100 yesterday. So I'm giving you recent examples. Also, this is yesterday's performance. So what's components? So within the NASDAQ, there's many different stocks, okay? There's 100 stocks. Each of those stocks have a different influence, a different weight. This is how it's known within the market. So for example, Microsoft is the most influential stock. Why? Because almost 9% of the NASDAQ is made up of Microsoft stocks. So it's got more influence over the price. Whereas if we're looking at Intel, for example, well, it's 1.36%, still quite a lot. So 18th most influential stock, but it's not 9%. So you can really see here the importance. Now, how is this going to help us with the price movement and false breakouts? Yesterday, we had a very strong downward price movement. People could have been looking at it as a breakout as well. It was quite a strong price movement. I don't think the false breakout would have had an issue. Anybody would have had an issue with if they were trading out at the breakout level here, unless they were keeping open to the trade for too long. In which case, the issue is not the false breakouts, something slightly different. But let's say, even so, the price movement didn't maintain, didn't keep momentum, and then it moved in the opposite direction. So how could we have determined this? We're looking at the 20 most influential stocks and the influence of these stocks, okay, and looking at the performance. So if we're looking at the most influential stock, we're looking at a decline. But the second most influential is actually increasing in value. Not much of a difference between the two. Meta is declining by 3%, but Nvidia is increasing by almost 5%. That's a lot. That's the biggest price movement we can see here. So the price movement is mixed. We've got stocks increasing by quite a lot. Some stocks are declining. So nothing's really indicating to us a lasting longer term trend. So I know that when this price movement is declining, is it really going to decline? Because here it's really a 50-50 scenario. If we account, for example, what's increasing, what's declining, we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 stocks are declining. 11. Is that really enough for this downward price movement to continue, okay? Whereas if we were looking at 15 stocks decreasing in value, okay, and ideally these 3 most influential stocks to be decreasing in value, then indeed, okay, that's really a scenario where the price potentially can maintain downward momentum, all right? And the same thing happens afterwards. When we get upward price movement, same thing. Is that upward price movement going to continue in the same session? Maybe later on, for example, today and tomorrow, maybe it will. But in that session, is it going to go into a higher high and form a breakout? I don't think so. Why? Because the scenario here is mixed. It's 50-50, all right? Then we've also got indicators. You can look at oscillators. Oscillators are very helpful with forced breakouts, whereas trend and momentum-based indicators are not so helpful. So as we get downward price movement, here I've got an RSI on an 18-bar period. Now, as soon as it hits 25, and you can see it hit 25 here, it indicated to me that the trend was going to change. All right. So oscillators can really help you. Is the price oversold? If the price is oversold, is it really going to continue in that direction? Also, what you can do is look at indicators on other time frames, not just the 5 minutes. Yes, the 5 minutes is probably the most important for derivatives because we want to enter, earn a profit, close as quickly as possible. But still look at longer term time frames. Still look at your 1 hour, your 2 hour, your 3 hour, your 4 hour. Okay, and try and look at where signals are not conflicting. Okay, because there's a lower possibility of breakouts there. Then we've also got the MACD. Here we can see the MACD bars are increasing, indication of a change there. Here we can also see the bars increase above the signal line, indication of the change there as well. So there we actually got an indication slightly higher, somewhere here. So again, here we can see it's given us an indication that the breakout is actually going to fade away and it's going to correct back to the previous range. But we could have already have seen that from looking at the components anyway. Now, ladies and gentlemen, we've been speaking for exactly 1 hour. So let's end today's session. I've got some questions. I will answer these questions. I've got 2 questions. If anybody has any more questions, feel free to ask now. Do we have replays of the past webinars where we will not be able to, where we're not able to join? The best thing to do is register for future webinars. If you don't join, we will send you the recording. If you also have something in mind, a previous webinar that you missed that you want a recording of, speak to the support team. They will provide you with the recording. Also, we've got a lot of webinars and videos on YouTube, so definitely subscribe to us on YouTube. We've got somebody who says that's the strong initial candlesticks that breaks out from the resistance or support curve. I'm guessing this is answering the previous question. This is confirming the previous question. So when you get a lot of volatility, to answer the question, when you get a lot of volatility and it forms a breakout, because there's a lot of volatility. As well, if you're looking at oscillators, because of the lot of volatility, you'll probably give you an indication of oversold. There is a possibility of there being a false breakout. So you have to be cautious about where there's a lot of volatility on that first candlestick, rather than there being stable, traditional price movements in a direction. But again, what you can do is, of course, wait for the breakout, wait for it to lose momentum, wait for it to correct, and then trade the continuation. So how do we work on breakouts on volatile commodities like gold? The exact same way, ladies and gentlemen. And some of these charts are also from gold. Let's have a look. I can show. So for example, this chart, ladies and gentlemen, is from gold. This is a chart from gold. Okay, so it works in the exact same way. So we've got a breakout here. We've got the breakout. I wait I don't trade. I wait for it to correct back downwards, and then trade the continuation, rather than trying to trade here. So if I trade here, yes, the price moved in my favor if I entered on time. If I didn't, I entered somewhere up here, would have been a bad trade. But either way, the price moved against me before the price starts moving in my favor. So why not wait for it to move against you and then trade the continuation of the trend? I'm not saying trade against the trend, but the continuation of the trend. And like I always say, measure previous impulse waves. So here we got an impulse wave, here we have an impulse wave, and here we have an impulse wave. Here we have a retracement, here we have a retracement. Measure this, measure this, measure this, okay? Measure the retracements as well, okay? Make a note of them. What's the average size of the retracement? What is the bracket? Retracements are normally between 0.20% and 0.35. The average is 0.26, okay? So you know, now that the downward price movement is happening, I know before it even happens that on average it tends to lose momentum here. If it's not and is larger, then I really need to look at a different scenario. Is it really going to be a trend continuing? And let's say it does go to that level and does continue upwards, and we're here, I know that it's going to go up to here, okay, on average, because this is the traditional price movement under the current market conditions. Which website gives you information about component analysis? Very simple. Go to Google, type in NASDAQ components. It will give you the exact same charts which I'm using, okay? Just type in NASDAQ components, open any one of those websites. I think the top website is this website here, okay? If it's not, it will be the second or third, but you'll definitely find it. It's exactly like this. And it confirms to you what's the most influential, so you can see it's ranked. It will confirm to you the most influential, and it will show you here today what price movements there is. So ladies and gentlemen, let's end today's webinar because we've had a lot of questions. I can see most people have left. We've only got 26 people who are still in the webinar. Thank you for your questions. As always, trade safe, trade responsibly. If you have any questions, feel free to get into contact with us at any point. In the meantime, enjoy the rest of your day, and hopefully we'll see you very soon on our next webinars. In the meantime, goodbye.